Good evening, everybody. This is Howard Friend, and this is my weekly webinar. Today, we're talking about trend trading using the break and retrace trading methodology, how to profit from market traps. So this is the outline of the presentation. First of all, market traps, what are they? How do they form? I'll talk a little bit about break and retrace methodology, which is my own trading methodology. I'll talk about technical chart-based traps, and the 1-2 pattern is what we'll be talking about today. It's a specific trading setup which can give you a good idea as to when a correction has completed and the market is ready to resume its trend. The orders that I use in my trading strategies, I'll go through those. I'll talk a bit about limit orders and stop orders and time-based exits. Then I'll go through some of the trading strategies, or one of the trading strategies that I use for trading the 1-2 trading setup. I'll summarize, then talk a bit about money management and any questions we can do at the end. Okay, so first of all, what are market traps? Well, my theory is that many of the big moves that we see in the markets occur typically after a false breakout of some kind. I call these setups market traps. The traps are formed when traders are caught on the wrong side of the market. Often they will form after a technical or a chart-based move, but sometimes they'll have a fundamental trigger, for example, a news move, as we talked about last week. So I've developed a trading methodology which I call break and retrace to capitalize on these market trap situations. So this is how the buy setup would look. So before the setup unfolds, we have the market at a fixed area, a fixed point, which I call the news origin, or the support or resistance origin. So the origin of the move. So in the bullish example, what we're looking for is a break to the downside, which is completely retraced. So the market breaks through a support level, for example, or sells off on a piece of bearish news. But after a certain time, if all of the move has been retraced, in other words, we get back to the origin point of the move, then a trap is said to have formed. We know that all of the sellers on or after the break have been trapped, and that creates the conditions for a powerful rally going forward. So with these technical or chart-based trap situations, what we have is a break. The market breaks through a support level for a buy setup or above a resistance level for a sell setup. If the move fails to see follow through buying or selling, then those who bought or sold on or after the break will start to exit their positions. And then we start to see a retrace. The setup is complete, in other words, the trap was formed if all of the move on the break has been completely retraced, 100% retracement of the break move. Once that's happened, then we're looking for a big move in the opposite direction to that of the break. So let's talk about the bullish 1-2 trading setup on the 1-2 pattern. So this forms typically after the market has had a strong move to the upside, usually involving several what I call thrust bars, where the close is above the previous bar's high. So that's the move which gives us the directional bias. So now, after seeing a thrust move to the upside, a good move, a good sign of strength, we're then looking for a correction. And I define this correction as breaking through the previous bar's low, but also leaving behind a lower high. So what effectively we've got is a bar or a candlestick where the high is below the previous bar's high and the low is also below the previous bar's low. So that's the break to the downside. It's anti-trend, it's against the trend. So we're looking for the sellers of that break to essentially realize they're on the wrong side of the market. So if that move to the downside fails, as we expect it would do within a bullish trend, then we start to get the retrace to the upside in the direction of the trend. And before you know it, we're looking for the trend to resume within a few bars. So this is how the setup looks graphically. So what we've got, we have a good swing to the upside. Now this swing could be defined as anything from a series of higher highs and higher lows. It could be price above moving average. You can identify the bullish setup in any way that you want using technical analysis. I like to use, as I say, what I call thrust bars, where the market closes above the previous bar's high. So maybe 2 or 3 of these thrust bars in the consecutive can give you a good sign of strength. So once you've got your sign of strength, then you're looking to buy after the pullback. You're not buying as soon as you see the sign of strength, you're buying after the pullback, which follows it. So how do we define this pullback? As I say, we're talking about the market breaking through the previous bar's low. Now, these could be daily bars, these could be hourly bars, could even be monthly bars. So we're looking for the market to break through the previous bar's low, but by the end of the bar, we've left behind obviously a lower low, and we've left behind a lower high. Okay, so we've got a lower high and a lower low, and I mark this as a 1 on the chart. Okay, so that's what I like to call a 1 down. So we have a swing to the upside, a 1 down. So that's the break using break and retrace methodology. So where does the trigger come? How do we know that the correction has finished and that we should take a long position? Well, I look for, having seen the 1 to the downside, I look for the break above the nearest 2-bar high. That's what I call the setup 1, 2. So we have a 1 to the downside, and then we have a 2 to the upside. So essentially what we're doing is when we break the red line, we're making a 1. Okay, that's the 1 down. So that gets us ready to buy. But we can't buy the market until we've broken through the nearest 2-bar high. So at the end of the 1 bar, the 2-bar high actually is here. The blue line would be here. So on the next bar, we try to break up, don't break through the 2-bar high. At the end of this bar, the 2-bar high has come down to this point. So now the 2-bar high is even closer. So on the next bar, we can then buy the break of this blue line. Okay, so we have a 1 to the downside and then a 2 to the upside. It's a buy, looking for a continuation of the bullish trend. So let's see a few examples of the bullish 1, 2. First example is Euro Yen, daily chart of Euro Yen. And the chart starts off with a good sign of strength. So what we're seeing here is several consecutive thrust bars where the close is above the previous bar's high. So this is aggressive demand. This is what we need to take us into a bullish situation. But we don't buy after seeing them, we buy after seeing the correction which follows. So here's the sign of strength. Here, double thrust, I like to call it. Consecutive thrust bars is known as double thrust, so 1, 2. Then we're waiting for the correction. Okay, so typically after a double thrust, the market likes to correct. So here's a kind of a bit of a doji or a push to the upside, but a narrow closing range at the end of the day. And then we start to see the correction. So we've broken now through the red line. The red line is the last higher low. Break through it. And at the end of the bar, we look back and we say, did we make a lower low? Yes. Did we make a lower high? Yes, we did. So this is a 1 down. Okay, so we've had a sign of strength, bullish swing, which makes us bullish. Then we've had the 1 down, which gets us ready to buy when we get the break of the 2-bar high. Next bar comes along. Do we make a break through the nearest 2-bar high on this bar? No, we don't. We break through the previous bar's high, but we don't break through the nearest 2-bar high, which happens to be the swing high. So at the end of this bar, the nearest 2-bar high is in fact the high of this bar, this blue line. Next bar, we can buy the break of it, break through it, up it goes, aggressive demand again. So we're seeing the mirroring of this initial swing. That's what we're after as a swing trader. Swing, correction, swing. Okay, so we have our big update on the breakout. Next day, bit of follow through, and then that's the end of the move, or that particular move. Double thrust. 1, 2 consecutive thrust bars. Next example. This one is Kiwi dollar, daily chart Kiwi dollar. And as with the previous example, we start off by seeing a bit of a sign of strength. We've got 3 consecutive up closes, 1, 2, 3. That's a sign of strength, in my opinion. Having seen that, we're waiting for a reason to buy. And that reason to buy comes after we've seen the correction lower. So on this bar, we break through the red line, which is the last higher low. And at the end of the bar, we look back and we say, yep, we're bullish, but we've had a lower high and a lower low. That sets up the trap. That's the break to the downside. So where can we buy this market? On the nearest 2-bar high. Where does that come in? Does it come in there? No, it doesn't. That's just 1. Does it come in there? Yes, it does. So this is the nearest 2-bar high. So on this bar, we can buy the break of this blue line. Buy the break, boom, boom, double thrust. Close above previous bar's high, close above previous bar's high. Take your profits, end of the swing. Market tops out. Another example here, this is dollar yen daily. In fact, a few examples on this chart, quite a lot. This is sometimes you'll find within a nice sustained uptrend or a downtrend, you see several opportunities to play this 1-2 setup. And this is a very good case in point. So the chart starts off with dollar yen pushing higher, thrust, minor correction, big thrust with an outside, double thrust. So 2 consecutive higher closes above the previous bar's high, double thrust. Nice demand. Minor pullback. Market then makes the lower high and lower low, which is a 1 down. We can then buy the break of the blue line on the next bar. Breaks through, boom, boom, aggressive demand. 2 consecutive days where the market closes above the previous bar's high. Profit potential from the long side. After the double thrust, as often happens, the market tops out and then we get a correction or a complete reversal. In this case, it was just a correction. So we're still bullish at this point, even though the market is struggling. We wait for the lower high and the lower low, which is the 1 down. We make the 1 down there, this bar. So on the next bar, we can buy the break of the nearest 2-bar high, which is here. The next bar comes along and closes. It doesn't happen. So at the end of this bar, the 2-bar high now is this high, this blue line here. On this bar, we can buy it, the break of the blue line. Buy it, up it goes. Nice aggressive demand. Tops out a bit earlier this time. Then the market goes into a bit of a trading range. We see another break to the downside, and then we get another break to the upside through the blue line. Big aggressive demand on the breakout, pushes higher early next day, and then reverses. But still, some nice opportunity there to take profits on the breakout trade. Still bullish. Market makes a lower high and a lower low. Where can we buy this market? On the nearest 2-bar high. Where does that come in? At the swing high, this blue line here. So on this bar, we can buy the break of the blue line. Up it goes, up it goes. Again, double thrust, close above previous bar's high, close above previous bar's high. Thanks very much. Time to correct. Another example, this one steps it down a little bit in terms of time frame. This is cable on a 15-minute bar chart. So as I say, the pattern of the setup can work quite well on bar charts or candlestick charts or just about any time frame. I would say that the longer term time frame, the better or the more reliable the pattern is, purely because on an intraday chart, there's a lot more volatility and a lot more random noise. But still, if you're a day trader, it can offer you some pretty good setups. In this case, what we have is it starts off a break to the downside. Actually, this one is part of a reversal 1-2, which I'll go a bit more into detail as we go along, because 1-2s are mainly they're good for trend continuation, but also they can also be quite good for trend reversal, part of a reversal pattern. And that was the case on this particular formation. So the market breaks down, makes a lower high and a lower low. That's your 1 down. The blue line is the nearest 2-bar high, which you can buy the break of on this bar. Up it goes, double thrust. 1, 2, time to correct. Same here. Not a great example that time. The market just went a bit sideways, although eventually it took off. Then the market corrects lower. We see the 1 down here, and then within a couple of bars, here we are breaking through 2-bar highs. Aggressive demand into the European close on this particular example. Okay, that's the bullish example. Now let's take a look at the bearish example. So how does that unfold? First of all, and this is in the case of the trend trading 1-2 setup, the market suffers a sharp decline. Now this can involve several thrust bars where the close is below the previous bar's low. It could be 3 consecutive closes below, 3 consecutive down closes. Could just be a visual inspection of a chart which shows a series of lower highs and lower lows. Could even be the market holding below an average, moving average. So once we've got that, we've got our bias. We've got a bearish bias. Now what we're looking for is the correction, the retrace. We're looking for the break in the break and retrace. So the market is breaking, in this case, through the previous bar's high. So what we've got is a higher high and a higher low at the end of the bar. Once we've got that in place, we have the break move done. So now we're getting ready to sell it on the retrace lower in the direction of the trend. So with this break and retrace setup, what we have is once the market has made the break and then there's a bit of struggling, then the market starts to retrace. And once we get a complete retrace, then we're looking for a big move in the direction against the direction of the break. So we're looking then for the downtrend to resume with a few bars. Here's the graphical example of the setup. So, as I say, the market starts off in a bearish situation. We then wait for the correction. So the correction comes, it's defined by the first higher high and higher low, which is the 1 bar. That's the break or start of the break move of break and retrace. Then within a couple of bars, 2, sometimes 3 bars, we're looking for the market to break through the nearest 2-bar low, 2. So we have the 1 and we have the 2. Once we've broken through the blue line, in this case, we're then looking for a kind of a mirror image, I guess, of the previous swing to the downside. We're looking for the market to start to trend lower. So let's see a few examples of the bearish setup. First one, Aussie dollar daily chart. So the market starts off by going a bit sideways, then we get this big break to the downside on this day, and a minor pullback starts here. Then we're waiting for that first higher high and higher low bar. So here is the 1 to the upside. So we've got the 1 to the upside. Now we're getting ready to sell a 2-bar break to the downside. So here's your 1. At this point, where is the nearest 2-bar low at the end of this bar? 1, 2, it's here. Okay, so on this bar, we can sell the break of this low, but obviously it doesn't happen. So at the close of this bar, we can now move up the blue line from here to here, because this is where the 2-bar low comes in, the nearest 2-bar low. Breaks through on this bar, that's the sell, boom, boom, double thrust. Close under previous bar's low, close under previous bar's low. Time to get out, take your profits, and move on. Market reverses. Dollar Canada daily. Now this is an example of the 1-2, but again, this is part of a topping situation. So this is kind of 1-2 reversal pattern rather than continuation pattern. So we start off here with the market obviously looking quite bullish, thrusting higher, all looking quite good. So at this point, we're actually bullish. We're not looking for a sell. We're actually bullish at this point. So what happens is the market breaks to the downside, so making a lower high and a lower low. So this would actually be a 1 to the downside, 1 down. So this actually gets us ready to buy the market on the break through the nearest 2-bar high. Okay, so at this point, we're on alert to buy the market, not to sell it, to buy it. Next bar comes along, and we do not break through the nearest 2-bar high. But what happens at the end of this bar is the 2-bar high comes down to this point. So on this bar, we can buy the market if and only if it breaks through, but it did not. The market pushed higher, didn't break through the nearest 2-bar high, so we have ourselves a situation where the bullish setup did not come into play. But what actually happened in this case was we actually set up a 1 to the upside. So we have a higher high and a higher low. So this actually sets up a 1 to the upside, which gets us ready to sell the market. Next bar, we break through the nearest 2-bar low, which happens to be there, and that's the sell. An aggressive move to the downside. So a lot of opportunity there to profit from a reversal 1-2. Market breaks down and then starts to correct. Hourly chart, euro dollar. So we start off with the market swinging to the upside, bit of a correction back to the downside, and then we start to move higher. We have a 1 to the upside here, higher high, higher low. And then within a couple of bars, we break through the 2-bar low, the blue line, and down it goes, double thrust, 1, 2, turn. Okay, so we now broken through support and it's starting to trend lower. We've got a bearish bias, so we're waiting for the 1 to the upside, which we get here. We get a higher high and a higher low, and we're looking to sell the break to the 2-bar low within a couple of bars, 2 or 3. And it happens on this bar here. We break through the blue line, boom, boom, double thrust to the downside. Not much in terms of pips, but maybe an opportunity there for the intraday spot trader. Market then turns around. We get the push to the upside. Within a couple of bars, we've broken through the nearest 2-bar low. Sell, boom, boom. Nice double thrust into the US close. Euro dollar daily chart now, going back to the dailies. As I say, the dailies tend to be, I'd say, probably the most reliable, and the weeklies and monthlies also can be quite reliable too. So what we have, this downtrend starts off with 3 consecutive closes to the downside, 1, 2, 3. So that gives us a kind of a bearish outlook over the very short term. So we're waiting for the push to the upside, which we get here. The 1 makes a higher high and a higher low. So that qualifies it for a 1 to the upside. So now we're looking to sell the break of the nearest 2-bar low within 2 or maybe 3 bars. And lo and behold, it doesn't happen on the next bar, but it happens on the bar after that. We break through the blue line and we see this aggressive double thrust. Close below previous bar's low, close below previous bar's low. After your double thrust, look for the correction. Time to get out of winning short positions. The market turns, little inside bar. We're still bearish, but we want to see the 1 to the upside. So the market then pushes through, makes a 1 to the upside, makes a higher high and a higher low. That's what sets the trap up. And then we're looking for the break to the downside, the blue line, which we get right there. So the market breaks through the support all the way down. Good opportunity for the day trader, I would say. Although it doesn't do a whole lot of aggressive selling at this point, but there is a bit of opportunity there for some short sellers. We're still bearish. Then we're waiting for another 1 to the upside, which we get there. We break through the red line, making a higher high and a higher low. So that gets us ready to sell on the break of the nearest 2-bar low. Doesn't happen on this bar, happens on this bar. Typically, the signal will come a couple of bars afterwards, because usually the next bar tends to be a bit of a indecision type bar, like an inside bar. So then we get the break to the downside and double thrust, 1, 2, minor turn. So good opportunity there for the swing trader here. Still bearish, market makes the 1 to the upside. On this bar, we break through yesterday's low, but not the nearest 2-bar low. So that kept you out of trouble from the short side. That would have been the trigger, didn't get there, so up it goes. But we're still looking to sell the break of the nearest 2-bar low. There it is, and there's a bit of an opportunity there. Not a great one, but certainly kept you on the right side of the market from a day trader's perspective. Okay, now let's just see a few more examples of both buys and sells on the same chart. So this is cable weekly. What we have here is, so these are weekly bars. So what we have is a bit of a indecision situation. We've got an inside bar, two inside bars there, and then we break to the downside here. We break through the bottom of the previous week's low. So we've tried to resolve this inside bar to the downside. But at the end of the week, we have the market closing back inside the previous week's range. It's left a lower high and a lower low. So that qualifies for a one down. So we have our one down, and now we put the blue line above the nearest 2-bar high, which is here. On the next week, we can buy the break of the blue line. It breaks through, boom, boom, double thrust. Close above previous bar's high, close above previous bar's high. And once you've seen your double thrust, time to take your profits. Market corrects. We're still bullish, makes a lower high and a lower low. Within a couple of bars, couple of weeks, we break through the nearest 2-week high, which is here. Nice big aggressive move during the week, closes very strong. And then the next week tries to push higher, but just hasn't got enough momentum. But certainly some good opportunity on the week of the breakout to make money. Market breaks down, market breaks up, market goes sideways. And then we have kind of a mirror image, I would say, of this situation. So what we've got here is an inside week where the high is below the previous bar's high and the low is above the previous bar's low. So that's your inside week pattern. Then they try to break through the top of it. We get this push through the top, but not enough momentum to see the market follow through. Closes back inside, just like it did here. And then we go back, closes back inside. So at the end of this bar, we've got a higher high and a higher low. So that's our one to the upside, that's break. Next bar we retrace all the way back down through the nearest 2-bar low, sell, boom, boom, double thrust, 1, 2. 2 consecutive weeks where the market closes below the previous week's low. Time to take your profits, market turns up aggressively. This example, this is dollar yen daily. So we start off with dollar yen looking bearish. We've got a good double thrust to the downside, then a minor bounce here, inside bar. We break through the top of it, leaving behind a higher high and a higher low. So that sets up the sell. That's the break. Within a couple of bars, 1, 2, we're breaking through to 2-day lows. That's the sell. Down it goes, thrust. Next bar, thrust, down it goes. Time to take your profits. Then buyers come in. There's quite a nice buying wave here. Excuse me. We have 3 consecutive up closes, including a double thrust, these 2. So this is aggressive demand. Market after the double thrust, as it typically does, 1, 2, the market likes to turn. So the market corrects lower after the double thrust. We're waiting for that lower high and lower low to get us ready to buy the market. We don't touch the market until we've seen that one to the downside. And it happens typically on a couple of bars later, which it does here. The market breaks through your blue line, boom, thrust, 1, 2, consecutive thrust bars, close above previous bar's high, close above previous bar's high, 1, 2, time to take your profits. Next day, the market pushes higher, but there's no momentum. So good opportunity from the long side there. So at this point, we're still bullish, but we're waiting for the one to the downside. We get the lower high, lower low bar here. So that's actually a one to the downside. So we can now buy this market on the nearest 2-bar high. The next bar comes along. Does it break through the nearest 2-bar high? No, it does not. So we've had a push here, doesn't break the nearest 2-bar high. But what it's done is it's made a one to the upside, where the high is greater than the previous bar's high, the low is greater than the previous bar's low. So we've got a one to the upside, which means we can sell the 2-bar break to the downside, which happens on the next bar. There's the breakout, and that's the start of this big collapse. So a very good short opportunity at this point here. Hourly chart, euro dollar. So we start off with the market kind of going sideways in Asia, as it often does, not doing too much during the Asian session. Then we get early Europe, we get a little push to the downside on this hour, leaving behind a lower high and a lower low, which means we can buy the nearest 2-bar high within a couple of bars, 2 or 3 bars, happens on this bar, and up we go, boom, boom, double thrust. So a nice opportunity there for the intraday trader. So we're trending higher, we're looking bullish, but we want to see 1 to the downside. We get the 1 to the downside here. Market then moves sideways and within a few bars, 3 bars here, we break through the nearest 2-bar high. Boom, boom, double thrust, close above previous bar's high, close above previous bar's high. 2 of those, time to take your profits. Market reverses. Then we get another 1 to the downside, which sets us up to buy, but we can only buy on the break of the nearest 2-bar high. Next bar comes along, we break through the previous bar, but we don't break through the nearest 2-bar high, which is here. And that leaves behind a 1 to the upside, which means we can sell the nearest 2-bar low, the blue line, break through, down. Okay, so that pretty much summarizes how pattern works, how the setup works, what I'm looking for when I'm using it. So before showing you the trading strategy, one of the trading strategies that can work around it, I just want to talk a little bit about the orders that I use. So obviously the typical orders that one would use would be a stop order and a limit order. Also, I like to use what I call time exits. So for those of you that are not familiar, a sell stop order is an order to sell below the current market price. So effectively, you're selling into weakness. You're not selling into strength. You're selling when the market falls below a certain price. So the idea would be to sell the market low and exit your short position even lower. So stop orders are used for entering short positions and for exiting losing long positions. A buy stop order is an order to buy above the current market price. So essentially you're buying into strength, not weakness. So the idea here would be to buy high and look to sell even higher, exit your long position even higher. So the stop orders are used for entering long positions and exiting losing short positions, the buy stops. Limit orders are the reverse. So a sell limit order is an order to sell at a price above the current market price. So what we're doing effectively is we're selling into strength. A buy limit order is an order to buy below the current market price, so we're buying into weakness. I use the limit orders not for entering trades, but for exiting trades in profit. So if I'm long, I want to place limit orders to sell above the market price to take my profits. Now, time exits are perhaps the order types that not many people tend to use or talk about. Time exits I find they're very good because obviously what we're talking about when we're trading these kind of setups is we're talking about market momentum. And market momentum can turn very, very quickly. So the idea is to get out of a trade after a certain number of time, a certain amount of time has elapsed. So as an example, if I'm in a trade using maybe an intraday chart, I might want to get out after, say, 3 hours. Or if I'm using a daily chart, I might want to get out after, say, 4 days. So it's just a means of putting a shelf life on the trade that you are entering into. So you're not just simply going for a profit objective and using a stop loss. You're saying, okay, well, if the trade doesn't hit my stop loss or my target after so much time, I'm just going to get out of the trade. I'm going to move on to the next trade. It's as simple as that. So the time exits are used for reducing risk. The idea, obviously, to exit a winning position before momentum can turn against it. Okay, so how do we trade the 1-2 buy setup? So first things first, we need a reason to buy the market. We need to be bullish. What would make us bullish? a sustained move higher, a series of higher highs and higher lows, maybe a 3 consecutive close setup or a double thrust, or maybe even the market holding above a moving average for a certain period of time. So that's the bullish setup, if you will. Then we're waiting for the market to make the one to the downside, the lower high and the lower low. Once we've done that, I say next 3 bars, next 2 to 3 bars, we're looking to buy at the nearest 2-bar high. Now, I say place a buy stop for 3 units just above the nearest 2-bar high. Why do I say that? Well, I like to enter my trades in a unit size which I can offer 3 equal parts for exit. So I don't want to take all of my profits at the same place. I want to take my profits at one place and then take a bit more higher up, and then maybe some more even higher up if we get to the target. If long, place a protective sell stop below the low of the LHLL bar. Could also use a tighter money management stop. So essentially what I'm saying is once we've had the one to the downside, I want to use the low of that 1 bar to protect myself, because if the market goes back down through that point, it tells me that there's something wrong with my setup. I also say you could use a tighter money management stop. Sometimes that 1 bar is very, very big. So sometimes a tighter money management stop could be the order of the day. With regards to the time exit, I've got one which I call the Brexit time stop exit. And it's nothing to do with the UK leaving the European Union. It's essentially the market breaks through the trigger level, the blue line, and then I'm waiting for the close of the next bar to exit the position. So what we have here, this is the buy setup. The market is bullish. This move puts us on the buy side of the market. We wait for the 1 down, which is this bar here, and then we buy the market on the breakthrough, the blue line, which is the 2. So we have the 1 to the downside, the 2 to the upside. This is the bar of the break, the entry bar. So at the end of this day, if it's the daily chart, we're still holding the position. We may have taken some profits, and then we wait until the close of the next bar next day, if it's a daily chart. And at that point, we can exit the rest of our position if we've not taken all of our, if we've not hit all of our profit targets. From the sell side, first things first, observe a sustained move lower. Series of lower highs and lower lows, maybe 3 consecutive down closes, maybe a double thrust, maybe the market holding below a moving average, that kind of thing. Something that gives us a bearish bias on the market. Once we've got our bearish bias on the market, we're then waiting for the market to make a higher high and a higher low on the same bar. That's the 1 to the upside, the break from the break and retrace methodology. Then I say next 3 bars, put a sell stop for 3 units just below the nearest 2-bar low. So if we break it, we want to be short 3 units. It could be 0.3 lots, it could be 30 lots, it could be 15,000 shares, any number that you like, as long as you are, when you hit your targets, you're selling 1/3 of your position. Okay, so if we go short, we want to protect ourselves with a buy stop. Where do we put our buy stop? I like to put my buy stop just above the high of the HL bar. Could also use a tighter money management stop if that distance is too big. And the time-based exit is, again, the Brexit exit. So we break down in this situation here, which puts us on a bearish tack. We're looking to sell the market, but we don't sell the market here. We wait for the correction. And the correction is defined by a market making a higher high and a higher low. Then within 2, maybe 3 bars, we're looking for breaking through the nearest 2-bar low at point 2. 1 to the upside, 2 to the downside, 1, 2, sell, down it goes, closes down here. But we hold this position until the close of the next bar, at which point we say thanks very much, because the market typically likes to double thrust. 1, 2, time to go high. So just to summarize on the 1-2 trading setup, So 1-2 patterns often form during strong trends and down. They can also form, as I've shown you, as part of a basing process or part of a topping process. So they can be continuation patterns, usually continuation patterns, but also they can form as reversal patterns as well. And they can be very powerful when used as reversal patterns because typically the holders of the market are dumping their positions pretty quickly. So the reversal pattern can sometimes be more aggressive than the trend continuation pattern. So the disciplined trader, what I like to say, the disciplined trader, the swing trader can benefit from waiting for these 1-2 setups to form before jumping into a trend. So don't just jump into a trend because the market's going higher, wait for the pullback and then wait for the market to start to go higher again, because that way you know that the probability of the market resuming its trend is much higher than it was previously. So 1-2 valid on all time frames and markets, but as I say, I guess the proviso here would be typically the daily charts, I'd say, are probably the best, and some of the other longer term charts, maybe 4-hourly charts, weekly charts, they can be quite good as well. But the lower down you go in time frame, I'd say the less reliable and the less profit potential that you have. And finally, I would say on money management. So if you're trading something like this, if you're using this as a trading strategy, this is a discretionary trading strategy. It's not a systematic trading strategy where everything is known in advance in terms of your risk. So you need to be extra vigilant when it comes to your risk when you're trading this kind of strategy. So I would say keep your trade risk constant as a percentage of your open equity. So if you're trading one lot all of the time, stay with one lot. Don't suddenly trade 2 or 3 lots just because you happen to like the setup. Keep the trade risk relatively small. I say don't risk more than 2% of your account on any one trade. Everybody is different in terms of the amount of money they are prepared to risk as a percentage of their account. I've got some accounts who like to risk up to 5%. I've got some accounts which will never risk more than 0.2%. So it just depends on your risk tolerance level. So even the best traders, systems, gurus, whatever methods will suffer drawdown periods. What is drawdown? A series of losing trades, not necessarily in a row, but as a series. So we could have win, win, lose, 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 win, win, lose, lose, and you are down from the start to the finish. So this amount of drawdown, in other words, the amount of money that you could possibly lose before you start to make profits, this should be allowed for as part of your trading plan. And I do separate courses, by the way, on how to structure a trading plan, how to set up your trading strategies so that you've got the right money management. And finally, I'd say be patient and wait for the traps to form rather than just jumping into the market. Better to let the market show you which way it wants to go before you take a bet. So I think now we will take a look and see if we have any questions. Let's see, I don't see any questions right off the bat. Does anybody have any questions on this presentation? It can be a bit of a strange concept at first, but once you've seen 10, 20 examples of the setup, then you soon pick it up, you soon get the hang of where the trigger levels are. No questions today? Okay, not a problem. So as always, I always say if anyone's got any questions, please don't hesitate to contact your CFI representative and they will pass them on to me, or alternatively, I'm on LinkedIn, not too hard to find. So if you want to find me on LinkedIn, I'd be very happy to answer any of your questions. So thank you very much for attending, everybody, and look forward to presenting same time next week. Thank you very much. Have a good one.